So this week we're continuing with chapter 7 regarding liabilities. And one of the main things with liabilities, as you saw, is calculating the bonds, the bond payable, the interest on bonds. So we're going to go over the example here. And this is for January 1, Drennan Inc. issued a $5 million face amount of 10-year, 14% stated rate bonds when market interest rates were 12%. The bonds pay semi-annual interest each June 30th and December 31 and mature on December 31, 2025. So the first thing to notice is there we have a coupon here and 14%, and then the market rate is 12%. The bonds pay semi-annually. What they actually pay is the 14%, 7% annually. Okay, and then we're going to go over what it means that the market rate is 12%. That means that there's an adjustment, right? So the question is, using the present value tables, chapter 6, calculate the proceeds issue price, which means what is the issue price? In other words, did the bond issue for 5 million? Or maybe it issued for less than that. So we have to look at the present value of the bond, and we can actually, it's something that we can actually calculate as well by doing the net present value of all the future payments. Okay, but what is the stated rate? So times the face amount, okay, times the period. So this would be the cash interest payment is $350,000 per period. So every period we book the entry interest payable, and this would actually be paid every 6 months. Okay, the term of the bond, the market rate, this is the market rate. Okay, so the market rate, okay, and this is, we're going to take the present value of this annuity, where we're just trying to see what is the present value, but the risk rate of this present value is actually 6%. Okay, so if we take this annuity factor of this paying over the maturity of the bond, that's the factor, and this is the amount. Okay, and then this is also 20 periods of, this would be a maturity amount. Okay, and this would be the factor and what it would be like. So the present value is the addition of these two factors. So that's how you use the tables. There's also another way to do it where you actually calculate it out. There's another exercise that we can go through. But this is important to understand that, also why is this higher than 5 million? In other words, this bond issues for more than 5 million. And you got to go back and look and see, and that's because, why would somebody pay more for that? Because they're getting 7% on something that's the risk is actually, 14%, where the risk is actually 12%. Or every 6 months you're actually getting a coupon for 7%, where the risk of this bond is really 6. So you're getting a little bit more. Okay? How much more? A little bit more than 6%. You're getting, 1/6 more than that, and that's why somebody would pay more for that. How much more? You use the present value factors to really calculate that piece. And that is how we do the present value. This is what actually ends up on the balance sheet as the bond payable in the beginning when the bond gets issued.